Have you ever found yourself driving
New Lamborghini.
thinking, where should I invest a couple $100,000? But then you realize you live in California and it only buys your cardboards? Well, me neither. I'm not from Cali. But not depending on your location and whether you're a skilled real estate investor or just first-time homebuyer, you need to know how to analyze real estate deals and preferably do it quickly. For most of the people out there, buying a house is quite an essential decision in their life. Because for the average American, the house is the largest asset they will acquire in their lifetime. This is why it's so important not only to buy a house with hardwooded floors in the neighborhood, but also to make a sound, reasonable investment decision. Without further talking, let's dive into it, and I'm gonna show you how to analyze a real estate deal in under 5 minutes. So firstly, you wanna start with calculating the cap rate or capitalization rate. The cap rate is defined by dividing a net operating income by the amount you pay for the house if you paid 100% in cash. So essentially the selling price. Net operating income is an income that you have after all expenses. So it's a gross income minus all expenses. And all of this is measured in annual terms, not monthly terms. That's important. Let's take, for example, a $100,000 house. So you paid $100K. Your potential gross income, $800 per month. So your potential annual income is equal to, you guessed it, $9,600 per year. Let's say you have some expenses like property tax, insurance, you have to pay your property manager, you have to also maintain the property to set away some emergency fund in case something breaks. So let's say in total you spend around $300 per month. That makes $3,600 per year. Now, in order to calculate your NOI or net operating income, you take your gross income and you deduct any expenses that you might have. In this case, it's $9,600 minus $3,600, which leaves you with exactly $6,000 in net operating income. That's your profit to keep before tax. And after tax, it's like half of that, but not about this. So you left with $6,000 in net operating income. You have a selling price of $100,000. That's the money you spent on this house. So your cap rate will be net operating income divided by a selling price. $6,000 divided by $100,000, which is 6%. 6% cap rate is actually pretty good, especially for some really expensive areas like Cali or New York. So the cap rate assumes that you paid all cash for the property. In most of the cases, you finance it. You take a mortgage, whether it's conventional 30-year fixed mortgage, but you can also take interest-only mortgage, which is really, really convenient to calculate because you only pay interest every month. So in order to calculate your actual return on investment, or cash on cash return, it's the same stuff, you need to divide your cash flow by the amount of money you invested. The cash flow is your net operating income minus any debt expenses that you have. So let's say you got 4% interest only mortgage on a $100,000 house and you put 20% down or $20,000, which leaves you with $80,000 in loan amount. Multiply that by 4%, that's $3,200 in interest annually. You take your net operating income, $6,000, you deduct $3,200 from this, and you're left with $2,800. Now you take this amount and you divide it by the amount of money you invested into this property. In our case, that's 20% down payment plus some closing costs. I'm guessing around $3,000 for such a loan, so that's $23K. So you take $2,800 and you divide it by $23,000, which gives us 12% cash on cash return or ROI, return on your investment. Now, with conventional mortgages, the calculation's a little bit more complicated. You would need to go online and search for a mortgage calculator, so you will see what your monthly payment will be. And then you will have to calculate cash on cash return. You will use this amount, principal and interest. In our case, it's $352. Now you know how to calculate cash on cash return or ROI using both conventional and interest-only mortgages. Those two parameters, ROI and cap rate, are the only two parameters you really need to know to quickly and somewhat accurately analyze a real estate deal. Of course, if you want to go into more detailed research, like getting to know the neighborhood, finding out if the new real estate developments are coming up on the market, or just doing overall general research on the market you are investing in, you would need to do more due diligence before you buy a real estate deal. But that's a whole topic for another video. Okay guys, thank you so much for watching. I hope you found this video helpful. If you didn't or you have any other questions, please feel free to leave a comment and I'll make sure to get back to you as soon as I can. Again, thank you so much for watching. Please consider subscribing to my channel, pressing the like button and notification bell, and bye bye.